Welcome to Forkast IQ. As the world accelerates into the digital economy, we're going to help you stay ahead with the latest in Web3, crypto, and data. It's where we look beyond just the headlines to get you the insights and knowledge that will help power smarter decisions. I'm Forkast's Megha Chaddah. The war in the Middle East between Israel and Hamas this week is the latest in the 7 decades-long conflict between Palestine and Israel. As the death toll rises and violence continues to spread, Israeli crypto firms have turned to the digital asset to raise funds. On Monday, Crypto Aid Israel was launched as an emergency initiative by several firms, including Fireblocks, Market Across, Crypto Jungle, Israel Blockchain Association, and Bits of Gold. The fund will operate through a multi-signature wallet jointly controlled by multiple parties to collect donations in Bitcoin, Ether, and dollar-backed stablecoins USDT and USDC. In a statement, Ben Samosha of Crypto Jungle said they hope to raise the necessary funds to provide food and shelter for families who lost their homes. Samosha added they are also hoping to provide hygiene and medical products for the bombarded Israelis and to raise awareness for the horrors the people are facing. Meanwhile, on Tuesday, the Israel Police Cyber Unit said it froze cryptocurrency accounts allegedly used by the Gaza-based Palestinian militant group Hamas for fundraising. The Israel Police said on X, the platform formerly known as Twitter, that Hamas also launched a crypto fundraising campaign after the start of the recent conflict, asking the public for crypto donations. The world's largest crypto exchange, Binance, has frozen accounts linked to Hamas militants at the request of Israeli law enforcement. Binance's co-founder Yehudah said the freeze is targeted towards Hamas and not the people of Palestine, according to a report in Cointelegraph. The restrictions spurred discussions about financial discrimination suffered by ordinary Palestinians. Wall Street Journal reported that Hamas raised $41 million in crypto from 2021 to June this year. Now, as airstrikes hit residential areas of the Gaza Strip, the war has led to over 1,000 people dead and many more displaced and torn apart from their families. We at Forkast hope the conflict reaches an end soon and peace is restored to the region. And in other news then, it's the second week of FTX founder Sam Bankman-Fried's trial in the United States. On Wednesday, the prosecution's star witness Caroline Ellison took to the stand. It's the first time the ex-girlfriend of SBF and the former co-CEO of his crypto hedge fund Alameda Research provided her side of the story on what happened in the lead-up to the collapse of both FTX and its sister company Alameda. Ellison testified she committed fraud at the direction of Bankman-Fried. Ellison also estimated that Alameda took around $14 billion from FTX customers, some of which was ultimately returned to repay lenders. She added that SBF planned to recoup funds by raising capital from investors. One of the key targets was Saudi Crown Prince Mohammed bin Salman. Alongside FTX executives Gary Wang and Nishad Singh, Ellison pleaded guilty to criminal charges, including defrauding FTX customers and investors. The 3 former executives have been cooperating with the prosecution. The trial is set to last until November, and you can find all the updates on it on Forkast.News. In the UK, the country's Financial Conduct Authority, or FCA, has rung the warning bell over 140 crypto firms. The list includes global exchanges such as Huobi, which is now rebranded as HDX, and KuCoin. FCA said the firms in the warning list are working without the agency's permission. In a statement sent to Forkast, Emma Ho of KuCoin said the company is not currently operating in the UK, nor do they have any offices or employees based there. She added, however, that KuCoin is committed to continuously monitor the regulatory landscape and adjust their products and services accordingly to ensure compliance with relevant laws and regulations in each country. Meanwhile, in a Bloomberg report, Huobi also said that HDX does not operate or market its products or services in the United Kingdom. The Israel-Hamas conflict has upped the uncertainty for financial markets. Crypto markets and Bitcoin in particular cracked even as oil and US stocks rallied. Let's get in Caroline Bowler of BTC Markets to break down all that we are seeing and what's ahead. Caroline, welcome to the show. It's good to see you.
Thanks so much for having me.
Now, rising geopolitical tensions are weighing down on crypto markets. Traders have suffered over $100 million in liquidations. How will it play out?
The expectation would be rising oil prices, as you say, an additional tightening. We know more broadly that there's no sign of the interest rates being repealed anytime soon. So that cash tightening, that belt tightening that we're experiencing is going to continue. That will have an impact on certainly on the volume traded around cryptocurrency, and keep it, I suspect, in this rather muted pattern that we've seen pretty much with with tight price rates since March of this year. So my expectation would be that now, with the crisis that we're looking at, that is at the very least going to continue until into probably Q1 at the earliest of next year.
The world is watching the SBF trial. What impact do you think the proceedings will have on crypto markets?
It's also absolutely prompted regulators around the world to pull at their socks and really look into what's happening in the crypto industry. Because here's the bit that's important to note. There are good actors in the crypto industry. There are good players in the crypto industry. And it is to our benefit that these kind of trials happen, that justice is seen to be served, that investors receive some kind of restitution for their losses, and that we can then, as I say, turn the page as an industry into what hopefully will be a far more positive future in 2024 once we get past these global macro trends that we've spoken about. So in some senses, I do think this SBF trial is really important and really critical for the industry as a whole.
Well, talking about investments, inflows in crypto investment products reached $78 million last week, with Bitcoin taking the lion's share, followed by Solana. But Ether future ETFs had a slow start since their launch last week. Why so?
So we need to put it onto a global scale. I mean, these are still very, very small, and I certainly wouldn't take it as indicative of what will be a wider investor appetite once liquidity returns into the market and crypto financial products themselves are better developed. Still very much in the foothills of this sector. So Bitcoin is the number one. It's 50% of the market at the moment, and Ethereum, I think it's about between 17 and 20% at any one given point. The thing with Ethereum, though, is almost as though it needs to raise its profile. I'm talking outside of crypto. I don't necessarily know that people understand what the distinction is between Bitcoin and Ethereum, or even why an Ethereum ETF or any other investment products are worth a look at.
Let's move to your home ground, Australia, then. Now, the Senate there rejected Senator Andrew Bragg's Digital Assets Bill 2023, and they've suggested further industry consultations to develop better regulations. Tell us about, when do you expect to see regulatory clarity in Australia?
I think the first paper we're expecting to come out imminently relates to crypto custody. And that's obviously going to be very important given the questions say around FTX and what happened to clients crypto with regards to crypto regulation. I know obviously the Treasury team are working extremely hard on it, but I think that without kind of the broad consensus of political will, it's quite challenging to get this thing through with any kind of expediency. We're just not kind of seeing the same level of attention and traction that it had under the prior government. This is a problem for Australia. If Australia is to retain its position regionally as well as internationally as a financial powerhouse.
Regulatory clarity is the key to progress. Thanks, Caroline, for joining us today. It's always a pleasure.
Thank you so much.
Well, time for a quick break then, but we'll check in on the NFT markets when we return.
Forkast.News is your gateway to all things blockchain, breaking down and breaking through the noise with the people who know it best and why it matters. We go to where the action is, from Asia to the world. Forkast is the most reliable source of intellectual discourse and insight that informs, educates, and bridges the gap between the blockchain industry and the mainstream. The future is being built, and Forkast has it covered. This is Forkast.News.
Thanks for staying on with Forkast IQ. Now, remember 2021 when China banned all types of cryptocurrency transactions? Well, a recent report from Cointelegraph suggests the country may be opening up to the idea of NFTs or non-fungible tokens. State-backed newspaper China Daily is looking to create its own metaverse and is looking to give a 2.18 million yuan, that's about a $390,000 project, to create an NFT platform. The platform will allow uploading and managing digital collections with pricing, bidding, and a multi-currency settlement system integrated into the platform. Now, this certainly feels like a sign of changing times. Could China's official go-ahead be the bomb NFT markets need? Well, that's because it's been yet another tough week for the NFT ecosystem, and our data analyst Yehudah Petscher joins in to talk more. Yehudah, could October bring respite for NFTs?
All right, let's start with something that people have been hearing about on a daily basis now for the past couple of weeks, and that's the Uptober conversation. Uptober refers to crypto, which traditionally sees an upmarket in October. More specifically, though, that's Bitcoin, which 8 of the past 10 years has finished higher. Now, on the NFT side, people are wondering if Uptober extends to this market as well. I wrote about this last week in my newsletter with CryptoSlam, highlighting how actually the past 2 Octobers were consistently down for NFTs, so I've been calling it Floptober. We'll see how it plays out by the end of the month, but as of the first couple of weeks here, well, the Forkast 500 NFT index reflects that the market is down. Now, I'll be happy to admit I'm wrong if things change by the end of the month. I don't think they will. I'm definitely expecting a Floptober in NFTs again. Now, the first week of October followed all trends when it comes to sales. The market was down again in sales volume, unique sellers, buyers, total transactions as well. This was the 7th consecutive week of declining sales in the NFT market. This week, those sales coming in at $55 million. That's across blockchains, yet again putting us at levels we saw in January, February 2021. The low volume was accompanied by some unfortunate news that reflects the state of the NFT economy, and nobody was immune. Last week, we saw a Tezos art NFT platform that announced they're closing in the upcoming months, but we also saw some layoffs that are coming from some of the biggest brands in Web3. Yuga Labs, the creator of the Bored Ape Yacht Club, the Other Side Metaverse, and the owner of the CryptoPunks, well, they announced a major round of layoffs last week, and this was accompanied by news that they're making a rather significant change to their game plan. Daniel Allegre, the CEO of Yuga Labs, said, "It's a challenging time not only for our industry, but also for the global economy. We must stay focused on our core strengths as we continue to create unique, engaging experiences for the broader Yuga audience." Now, Allegre went on to say that this restructure, well, it impacts the USA teams right now, but they are looking at the international teams as well. So expect some changes, probably some news coming about layoffs over there as well soon. Yuga Labs stated that they will now make their Other Side Metaverse their core focus, and they'll bring their MeBits and 10KTF collections into a much larger role within that ecosystem. All of this differs from their prior efforts that saw them creating multiple gaming experiences like Dookie Dash and the Heavy Metal Forge. On the community front, Yuga Labs is bolstering their support for their Made by Apes platform, which is their licensing platform, and ApeFest 2024 is coming in just a few weeks. That's taking place in Hong Kong this year. So the bear market took a significant bite out of one of Web3's biggest native brands, but the changes made will hopefully serve them well into the future. Yuga Labs wasn't the only one announcing layoffs last week. Proof Collective, which is Kevin Rose's group behind the Moonbirds collection and the Art Grails, also Oddities, well, they announced layoffs as well, cutting their team's size and offerings down in an effort to build a much more sustainable ecosystem. Proof Collected had raised over $50 million in a fundraising round, also brought in over $60 million from their Moonbird primary sale. Seeing a project with that type of money at their disposal, making such a significant change, is of course concerning to holders. And some of those holders selling these NFTs in bulk, that's including Ryan Carson's NFT fund that purchased 607 ETH worth of Moonbirds last year, just last week sold the entire lot of them for just over 33 ETH. Pretty huge loss there. Last week, we saw a Tezos marketplace called Versum announce that they're closing their doors this year. Versum was well liked by both artists and collectors. Now, early on, NFTs purchased on Versum could only be traded on Versum, and I suspect limiting collectors' opportunities to sell significantly impacted their ability to grow during a very crucial time. Now let's shift to the building that is happening in NFTs. The Pudgy Penguins, who 2 weeks ago announced their partnership with Walmart that brings their toy line to 2,000 stores across the United States, well, they now announced that Smiths in the UK will also be carrying their toys. Luca Netz, the CEO of Pudgy Penguins, said they've already sold 25% of their supply at Walmart, well on their way to meeting their objective of 70% of that supply being sold out. Netz, however, came under scrutiny last week for some of his previous business practices, which included drop shipping and online course offerings, both being labeled as borderline scams. Whether this will impact the Pudgy Penguins brand or their NFTs remains to be seen. We'll keep on top of this developing story over the next few weeks. And finally, OpenSea released a new way to mint NFTs with their new Creator Studio. This does away with OpenSea's traditional way of minting, which on their website they referred to as lazy minting. Now creators can mint entire collections on OpenSea on their own contract, and they can choose from an assortment of blockchains to mint on. And these NFTs, well, they can be purchased with credit cards, so this is a huge addition for the NFT space. There's a downside here, though, that's left the community largely unimpressed, and that's that OpenSea's taking a 10% cut of all NFTs sold via primary sales. That's on top of an existing 2.5% transaction fee. Now's the time for other platforms like Manifold, Rarible, and Blur, maybe even some newcomers, to come take market share away from OpenSea. We'll see just how the NFT ecosystem shifts from this. There's no denying that it will shift. That's just the nature of Web3. Back to you.
On that note, let's take a quick break then, and we'll talk about how blockchain is enabling tokenization of traditional industries like real estate on the other side.
Forkast.News is your gateway to all things blockchain, breaking down and breaking through the noise with the people who know it best and why it matters. The future is being built, and Forkast has it covered. This is Forkast.News.
Welcome back to Forkast IQ. Tokenization of real-world assets, or RWAs, has caught the investors' fancy despite bearish market conditions. Switzerland's largest bank, UBS, launched a trial of tokenized money market fund on Ethereum last week. From gold to art to securities, any and all kind of assets are up for tokenization. Forkast Mahashal looks at the tokenizing potential of real estate in the first part of a series that looks at placing real-world assets on blockchain.
Economies across the globe are embracing tokenization. But what exactly does tokenization mean? It's the process of digitizing and representing assets as tokens on a blockchain, and anything and everything it appears can be tokenized, from financial products like stocks and bonds to physical items such as art and houses to virtual assets including carbon credits and intellectual property. But why do we need tokenization? It creates a granular virtual investment vehicle on the blockchain, which can then be traded on digital platforms. According to a report by Boston Consulting Group, the market for tokenized assets could grow to $16 trillion by 2030.
So you can see Fidelity, Franklin Templeton, BlackRock, KKR, and some of the sovereign wealth funds and investors in the area that you're living in are thinking deeply about how actually to make these markets accessible and more efficient when investing. And certainly blockchain will enable this kind of infrastructure to be much more efficient, much more transparent.
Bernstein estimates the size of tokenization opportunity to reach $5 trillion over the next 5 years, led by stablecoins, central bank digital currencies or CBDCs, private market funds, securities, and real estate. But why are institutions interested? The answer: increased liquidity.
Now we're at a point where the crypto scene has become so large, they're actually wanting to, leverage that liquidity. So liquidity, the access to global crypto liquidity, has been another huge factor in the reason for that level of interest in RWA tokenization from traditional financial institutions.
According to experts, tokenization brings many advantages, including cutting down on middlemen, faster transactions, increased transparency, and in the case of real estate, opening the market to a wider pool of investors. Let's take an example. You want to buy a condominium or an individually owned residential unit in a building. How would tokenization help?
I'm really talking about tokenization of each little condo in like being in the land register. Then it will basically mean I can invest 100 euros at the end of the month in a particular tokenized asset class, in a tokenized asset of this particular condo. So I can make a monthly payment, I can make an upfront payment, I can share the ownership with hundreds of other people. If I want to sell it, I do it within seconds. Fractionalization first. Second, as soon as fractionalized, it opens up a much bigger market. So it brings much more liquidity and a third, it also makes it much more international.
So what are the pain points in real estate?
Look at the housing market, our real estates. Yeah? So very illiquid, expensive to exchange, not possible to get a super small fraction of this asset class, and so on and so on. So there are problems, so to say, that are just waiting to be solved.
Illiquidity and housing bubbles are ranked high as challenges facing the industry. However, tokenization is still in its infancy stages and lacks regulatory clarity.
When you think about fractional ownership of real estate, we really have to go back to each individual jurisdiction where this is anchored. Let's say a 10th or a 30th of a very expensive building that I purchased a certain share of with a tokenized instrument. How can this ownership be claimed? How can it be enforced? Which then needs to be rooted in a legal concept that is valid in the real world.
And coming up with rules is not easy.
What the law has to do is think of some way to ensure that when, say, I transfer a token to you, and we both intend that that transfer of the token will be mirrored in the real world with the transfer of the real thing, the law has to find a way of making that the case. And that's actually, in some ways, incredibly difficult.
Tokenization holds the key to revolutionize the traditional financial system and create greater liquidity. And we are just getting started here. Megha, Forkast.
It's during times of war and macroeconomic challenges that people seek out alternative banking methods. And Web3 enables faster, cheaper, and secure transactions that sidestep traditional institutions. As we witness a financial transformation, what roles will banks play in the future digital economy? Our next episode of Word on the Block with Forkast Editor-in-Chief Angie Lau and Alex Tapscott might be able to answer that question, as well as a few others. Here's a sneak peek for now, and remember to catch the full show on Monday.
The question is, if we are going to see value, spread around the world, really in the darkest corners of the world, with people who, didn't have this access once before, and that blockchain and Web3 allows anyone, anywhere in the world to be able to participate in a financial transaction. What does this mean for banks?
Well, does it mean the end of banks, or does it mean the transformation of banks? I think where we're going to end up is in a world where banks are smaller, more innovative, more nimble, and less important. Basically, they're not going away. And when it comes to blockchains, I mean, this is a medium for value that removes the need for an intermediary from transactions. Now, I think that as there are lots of ways in which technology disintermediates middlemen, but there are also opportunities for re-intermediation, or what I would call application of new technologies for existing companies. So stablecoins, I think, are a really good example of this, right? So stablecoins are this asset that have found clear product market fit. They're a digital dollar, a way to move US dollars around the world peer-to-peer instantly.
This week, Angie is also at the D3 Bahamas conference, talking to the people who are shaping the future of regulations and why it matters. Listen in.
As the regulator, what are you regulating when the domestic demand of the investor, the average Bahamian, is not necessarily the investor of which we are talking about when we are building trust? Talk about that a little bit as you think about your role in Bahamas in the stage of blockchain globally.
So we don't really have a domestic market for crypto, meaning our locals are really not in this space in a big way. So the question would be then, why should the Bahamas go forward and try to regulate crypto? Why should we try to regulate digital assets? And the issue is really simple. We are an international financial center. And as such, if we don't have a framework in place, the danger is that a company can come to the Bahamas, they can set up shop, and we do not have the tools to address issues, to supervise, and to enforce. And so it's with that backdrop. And then I think there's another problem that is posed by crypto specifically and digital assets specifically, which is the question of a lack of a legal definition. And so what we set out to do with the DARE Act is we recognize that The scope of our regulatory perimeter did not allow us to regulate in an area that is not defined anywhere. And so we set out with DARE first to give digital assets a legal definition and then to frame the legislation around it.
Well, that's a wrap on this week's show. Thanks so much for tuning in. Remember to like and subscribe to this video if you're watching us online, or stay tuned right here on this channel if you're watching us from home. I'm Forkast Megha Chaddah. Join us again this time next week as we bring you the latest from the world of Web3 and why it all matters. Forkast IQ, get intelligent in Web3.